Good evening, everyone. My name's Paul Lynch and I'm the Regional Manager of the Brisbane office for Australian Catholic Super and Retirement Fund. Welcome to tonight's retirement planning webinar. We'll be commencing shortly. We're just waiting for people to come and attend the webinar. We've got quite a large crowd watching at their homes or their offices in tonight's webinar. Before we start, we've got a few housekeeping rules. Whilst it would be lovely to meet you in person, tonight obviously we're doing this via webinar. Tonight's session, we have Phil Johnson, who's a financial planner from our Sydney office, who also looks after the Canberra office. So Phil and I will be going through to tonight and sharing with you thoughts on retirement planning. So welcome tonight, Phil. Thanks for joining us.
Thanks, Paul.
Before we start, I think we just better take time out and do a welcome to country. So I would like to acknowledge the traditional custodians of the land on which I work and live, and recognise their continuing connection to land, water and community. I pay respect to elders past, present and emerging. Tonight's session, we need to start legally correct and make sure that when Phil and I finish this session that we're not going to get in trouble with our compliance people. I suppose the one thing that we need to remind people is that with tonight's webinar, it is only factual information. Now, I always say that if you can read this slide, then you're probably not ready for retirement because your eyes are still perfectly fine. The one thing that I would say is that both Phil and I tonight will only be providing you with factual information. If you do wish to have further information in regards to tonight's session, I would refer you to our website, www.catholicsuper.com.au. You will also find at that website our product disclosure statement and our financial services guide. These strictly outline and legally outline the requirements for operating the fund and the information that we provide. So in tonight's session, we will be fielding questions for you. We have Justin Colley, our Business Development Manager in our Sydney office on standby, and he's monitoring the chat and the Q&A facility. So if you do have any questions through tonight's session, please submit them there. Justin at the end of the session will provide us with the questions and hopefully Phil and I will be able to answer them here tonight. The one thing that I would say is that time permitting, we've only here for an hour tonight, time permitting, I would state that we may need to finish before we enter those, but I am sure that we will answer those questions to you privately as well, if we don't get a chance. The one thing that I would need to highlight to members first tonight is that you've probably heard the exciting news of the merger between our fund and NGS Super. I think if you've been witnessing any superannuation news articles, you're probably aware that there are a lot of funds in the merge phase, and our fund is one of those. We're merging with NGS to create, I suppose you could say, a very specialised education and community services and care superannuation fund for employees of the church. Now, tonight's session, we're not going to go into great detail of this, but we're working through this merger. We're going to be finding that over the next few months, we will be providing you with more information. But a merged entity will provide a greater, a more powerful fund in the sense that we'll have over $21 billion under management. We'll have nearly 200,000 members, which certainly means that we're coming together with similar values. They're predominantly education and care based as well. So we'll certainly be continue to have our connection to the church and continue to service the members with the values that they are used to in our fund. Now, the merger is not expected at this stage until February of next year. So a lot of water and work to go under the bridge to make sure that we review both funds to ensure that when we come together, we provide you with a fund that is strong, with the benefits of both funds together and the best product that we can combine. So certainly keep your eyes posted on the website there that's listed. And if you've got any further information, please do not hesitate to contact the call centre. So after a long-winded 5-minute introduction, Phil, in terms of now, let's start with the retirement planning side of the session, what we're all here for. I suppose the thing that we all have a goal of retiring one day. I suppose we all have different wants and needs in life, and we have all different expectations of what we would expect for our retirement to look like. Can you run us through what people need to mentally start preparing for getting ready to go into that next phase of retirement?
Yes, thanks, Paul, and good evening, everybody. Yeah, so as financial planners, when we're looking at retirement planning, one of the first things that we try to do is establish what people's goals are for their retirement. And obviously a big one is need a certain amount of money for retirement and things I want to do. Living costs obviously are a big part of that, but there's a lot of other things that people need to consider about what they want to do in their lives that maybe they haven't had as much chance to do while they've been working. And look, some of those things that are common that we hear, I've just listed below. A lot of people want to do more travel with the extra time that they might have in their retirement. Of course, the whole COVID situation has changed that at least for for the last year or so. Let's hope things are going to improve in that regard. We're certainly sensing that people haven't abandoned their plans to travel. So travel, cruises are another thing, a lot of common thing that people in retirement wanted to do. What are your hobbies? Going to the movies, camping, touring, gardening, all these sorts of things, and just spending time with family, grandchildren, all these sorts of things. Starting to make a bit of a plan about how you would like to, how these all these things that you do in your life, how much money they might cost, how much money you should budget for, and they can all start to be built into a financial plan about how you might achieve these goals.
Yeah, I totally agree. And I suppose many people ask the first question is, well, how much money do I need to have in retirement? I suppose the answer to that is that you look at what you've mentioned is coming along and saying, well, actually, no, let's not look at the balance you need. Let's look at what you need to spend or to sustain your preferred lifestyle in retirement. And therefore, that amount derives the amount that you need for retirement planning. I suppose the one thing that we can use as a guide, Phil, is what the government provides as the full age pension. So on the slide there, we've got the full age pension. And the one thing that I would highlight to you is that we've got the amounts there for a single and couple, and that's full entitlement. The one thing that I would state is that we will be doing a Centrelink retirement webinar at a later date. You can refer to the conditions and the eligibility criteria for age pension later. But that certainly is available in another webinar. So tonight we're just touching on, well, this is what the government provides as a backdrop. And you can see there around about 25-ish thousand for a single person and about 37-odd thousand for a couple is a full age entitlement. The one thing that I would say is that we have ASFA. Now, ASFA is a superannuation body that conducts a survey each and every quarter of people that are living in retirement all over Australia. Now, the one thing that I would say is that it's quite a detailed listing. If you were to Google retirement standard or ASFA retirement standard, you'll find the documents that we're referring to. You can download the full detailed budget version or just the abridged version of what people spend. So Phil, can you go through the differences between, or what the amounts are? We can see them on the screen, but also how they differ in terms of what expectations you would be seeing for these types of incomes.
Yeah, sure. Thanks, Paul. So yeah, I mean, ASFA, if you go on, as Paul said, if you go on the website for ASFA, it will break down some quite detailed information about what sort of things people spend their money on in each of these categories, be it a modest or a comfortable lifestyle. But in broad terms, I think it would be fair to say that a comfortable lifestyle, so it's about $63,000 for a couple, it represents, well, in all cases here, debt-free, needing about $63,000 to live on in this case. What sort of things are they spending their money on? What's sort of described as, yes, they're doing regular travel, within reason, because obviously you can spend an enormous amount of money on travel. But yes, they would be spending money on travel. They would be having what's described as a reasonable, reasonable car, which is updated on reasonable basis, and these sorts of things. Broad range of consumer products and things like this. Look, I would have to say to you that I, in my experience in retirement planning, there is a lot of people in Australia that are living on that sort of figure, and I feel that they generally feel that is in fact a comfortable retirement. Okay, modest would be more described as, yes, you're not going to be potentially doing as much of the travel or the discretionary things that a person on a comfortable lifestyle would do. So you may not. I certainly have clients that would be occasionally, doing maybe not an overseas trip every year, but they do budget to do an overseas trip on a comfortable budget of about 63. Probably not so much on a $40,000 for modest. So I think that's the sort of thing that you'd be aiming at. They're probably not, modest person is probably not going to be doing have enough money to generally do large renovations to the home, things like that.
Yeah, for sure. And I think the one thing that I always keep in mind is that we hear these stories about, or in the media, where they come out to say that the average retiree needs $1 million to retire on. And evidently from the data that we see in our fund, that's certainly not the case. A lot of members don't have that sort of money. The one thing that I would like to point out, and I keep reminding people, it's doing slight changes to your superannuation could mean just a $10,000 difference. It could mean the difference, and I always use the simple mathematics example, that there's about a $3,000 difference between the full age pension and that of a modest lifestyle. Now, if we're going to be living for, say, 30 years in retirement and we're needing around about $3,000, well, then that's around about a balance of 90 odd, nearly $100,000 a year that you need without any interest to produce $3,000 for each and every year. So I'd just like to remind people that if you've only got, if we're only looking at this $100,000 of superannuation assets, then that could mean a difference between moving from the full age pension up to that modest lifestyle quite comfortably. I suppose, Phil, do they have any, ASFA has some findings of the lump sum required to fund that for a single and couple person?
Yeah, I think for that modest, for the comfortable lifestyle, I think we've done our own work as well, which is I think it's about a bit over $600,000.
Yes,
is the amount that we've done, and to pick up on your point, Paul, obviously 600,000 is a lot different to $1 million, which is what a lot of people hear, and a large part of the reason why that is. Why people can afford to live on a comfortable lifestyle with that amount of money is because of the effect of the age pension.
Yeah, for sure. So certainly factor that into your threshold. On the next slide, whilst it's probably a bit small print, we've got the phases of comfortable, modest, and age pension. These are all just a snippet really from the comfortable document, or the retirement standard document that is there. So that's available. So it's really just the basics and going through from age pension at the basics level right through to a comfortable, where there's, just the nice touches in life. So yeah, so if you want, those people are, that is available. That study does assume, I'm pretty sure you can correct me here, Phil, it's assuming that you own your own home and debt-free at retirement.
Yeah, that's right, Paul. Yep.
Yeah, for sure. So I suppose when we looked at how much you need and how much you need in terms of cash flow, we look at the vehicles that you need to have a look at in terms of placing your retirement funds. Now, superannuation is one asset that you can look at. Now, within, or I should say it's a vehicle. Within the vehicle, you can create assets according to your member investment choice and take a risk profile that suits you. But the benefit of investing it in a superannuation fund is that whilst you're sitting in super, you get some concessions for contributing, and we'll go through those in a moment. But the investments that are sitting there are taxed at only just up to 15%. So the investment earnings as we earn, I always say that when the super fund earns $1, it could pay tax of up to 15 cents, and therefore the investment earning you receive net is 85 cents. So it's quite a good environment to grow your wealth and grow your assets for retirement. The one thing that we look at is that an account-based pension, which you need to use to purchase with just superannuation assets, so money needs to come in through a super fund door, you can look at taking an account-based pension or an allocated pension. Phil, obviously we've got nil taxation in that environment, but I would imagine that that has become I suppose, the vehicle of choice for retirees.
Very common. That's right, Paul. And obviously one of the big attractions of it is very hard to beat paying no tax on the earnings. It's outside of superannuation or allocated pensions, there's not a lot of investments that don't pay any tax, but especially with the flexibility that in terms of receiving a cash flow that an allocated pension can give as well.
Yes, certainly. So whilst we've mentioned the tax rates on the investment vehicle or of the superannuation fund, these are the taxation rates of individuals. Now, obviously, when we have interest or investments outside of super, they earn interest or earnings or rent or whatever, and they're taxed at your appropriate marginal tax rate. So you can see there that when you're comparing a superannuation fund tax of just up to 15%, comparing that to the individual tax rate, then having those investments within super is certainly very much more tax efficient than having investments outside of super. The one thing that we also got to look at is that you can top up your account by using salary sacrifice. Now, salary sacrifice is quite beneficial in the sense that when you forego income from your employer and have that contributed to your super account, it comes to the fund taxed at just 15% on entry. As you can see there, that anyone who's earning over $45,000 pays marginal tax at around about 34 cents if you're going to include the Medicare levy. So you can see there that with these slides, there is an instant tax saving or potential tax saving there for you to salary sacrifice. So I would imagine that that would become the most common form of building your wealth prior to retirement, Phil.
Very common, and you've just outlaid, basically the reason why, in that clearly from the table, once you get into anything over particularly 45,000, as you said, you're paying effectively almost 35% tax on your earnings, whereas in the superannuation environment, by salary sacrifice, you don't pay that. You don't pay that 35% anymore. You do pay a 15% contributions tax, but if you think about it, on the one hand, if you're saving at almost 35%, it costs you 15%. Your net saving is still 20% of your contributions, and that's basically in simple terms, that's how it works. It's and of course, once again, because of our progressive tax system, you're going to save more money the higher the income you earn.
Yeah, for sure. I suppose, Phil, is there anyone that shouldn't be salary sacrificing?
Well, yes. I mean, there's salary sacrifice does come at a cost. As I said, there's a 15% contributions tax. So the fund must give the government 15% of what you contribute when you salary sacrifice. And therefore, you need to save more than 15% to make it worthwhile. So clearly, if you look at the the top row of the table, well, anyone that's earning anywhere between up to $18,000, they're not actually going to pay any tax. and therefore salary sacrifice would be not only not to their advantage, would actually cost them money because they'd still pay the 15% contributions tax.
Yeah, certainly some benefits. I suppose the other thing is that we'll mention the limits. Before we start, we'll talk about, well, salary sacrifice forms part of concessional contribution. So what are concessional contributions? Well, we've mentioned salary sacrifice, but you've also got to factor into these thresholds your employer superannuation support. So whether it's the compulsory super or any additional super that they provide, they all count to the concessional contribution limits. Phil, can you give us a rundown? Obviously, when these contributions, they all come in and get taxed at 15% on entry, but obviously you don't want to be going over the limits. So can you take us through what are the limits and how they're changing from 1 July?
Yep. So sure, Paul. So currently the limit for concessional contributions is $25,000, and as it says on the top right hand side of the slide, government has recently announced that that limit will change to $27,500 from the 1st of July 2021. So that potentially for some clients will likely mean they have the potential to do a little bit more salary sacrifice. Yeah, so that's what the contributions are. It's probably also just worth mentioning that in addition to the salary sacrifice type of contribution, you can now make what's called a personal concessional contribution or a personal deductible contribution. It's listed there at the bottom of the list on the left-hand side, and not everyone's aware of what that actually is. It might just be worth just explaining to people what that actually is you're putting money into super. So it's not salary sacrifice, it's not coming out of your salary. It's your money that you're putting into super, but you're effectively able to claim a tax deduction for that. And that's of usually particular interest to people around this time of financial year, because there's the opportunity when people are getting close to the end of the year to be able to make some contribution to potentially just maximise the ability to reduce their tax.
The question I suppose I get all the time, Phil, is that what happens if you actually go over these thresholds?
Yeah, so well, you're going to get, the first thing, you'll get notified by the ATO from the tax department, but generally the principle is this: when you go over the limit, it effectively means you have been able to get a tax deduction which you weren't actually entitled to. So so what the government says is, well, whatever your tax, it comes out at your tax return. It's all reconciled when you do your tax return. The government will look at it and say, all right, well, because you made more contribution than what you should have, you saved more tax than what you should have. However, the government will acknowledge that when you made that contribution, you did pay a 15% contributions tax. So effectively, you're going to be repaying the government the benefit you got less the 15% contributions tax that you received, plus an interest penalty as well.
So by the sounds of it, when you start saying interest penalty, by the sounds of it, it's best not to go over. Well,
we always feel as financial planners, well, look, it's obviously the intention of the law is not to go over.
Yeah.
So it's not just that, but just from the point of view, not just the fine, but also the complexity of having to deal with the tax department. All these things are, are quite often quite stressful for clients, even if the amount of the actual penalty itself is not big.
Yeah.
So I always try to stay under.
Yeah, for sure. Just to remind people that if you do have any questions, you can use the chat facility or the Q&A facility. We've got Justin in the background keeping an eye on that for us. So if you've got any questions, we'll come back to those at the end. I suppose the other question is that we've gone through and looked at the concessional contribution limits. We probably should address that, well, that's not just the only way of putting money into superannuation. you can actually do top-ups, or what we call lump sum contributions, or what we call post-tax contributions, and a different threshold applies to those. So essentially, the rules have changed somewhat, and for this financial year up to or from 1 July, I would like to highlight the fact that these are the current rules that we're working with, so up till the 30th of June. The rule is if you're under 65, you can contribute up to $100,000. You can bring 2 other years forward and contribute 3 years in one financial year, or make a $300,000 contribution, providing you don't go over that threshold over a 3-year time frame. Once you turn 65 and 60, and you're over 65 and 67, the rules have changed somewhat in recent times. There's now no work test. So if you're below 67, you can contribute these funds, but you can only do the $100,000 if you're between 65 and 67. Once you turn 67, yes, still the limit is $100,000, but you need to meet the work test, and the work test is 40 hours over a 30 consecutive day period. I was just about to get them swapped around there, Phil. So it's a 40 hours over a 30 workday period. So that's for those 67 and 75. Once you turn 75, the rules essentially mean that you cannot push any more money through to your superannuation account. The door is closed. So I always tell people that if you're going to win lotto, try and win it when you're under 67, no work test, and then you can put this money in. You can use the bring forward rule if you're under 65, but it's limited to $100,000 if 65 and 67. But certainly once you start over that 67th age, the work test applies. So Phil, I would imagine that with these thresholds, or the concessional contributions as low as, down to $25,000, people may want to put in more. Do many use this non-concessional contribution ruling as well?
Oh yes, very, very, very common as well, and it's just by I guess by virtue of the fact that for $25,000, particularly if you're working or got some other income, or employer contributions are going into super already, $25,000 is not a large amount of money to contribute into super. When you're talking about the lump sums that people might want to invest when they're approaching retirement. So there's lots of different reasons why people might have these lump sums. Could be savings, could be inheritances, could be sale of an investment property, something like that. But when you're dealing with those sorts of things, quite often they're much more than $25,000. And so yes, it's these rules, and I'm speaking to people most days that are looking at utilising these types of rules.
I suppose the one thing that we need to remind people is that concessional contributions, when they come into the fund, get taxed at 15%, so your salary sacrifice. Can you go through the fact that what the taxation rate for these non-concessional contributions are?
Yeah, so there is no contributions tax on these non-concessional contributions. So the concessional contribution, it's a 15% contributions tax. However, you're claiming that contribution itself as a tax deduction against your personal income tax. However, with a non-concessional contribution, there's no tax, there's no contributions tax on the way in at all, but you are not able to claim it as a tax deduction against your personal income tax.
For sure. And I suppose, Phil, that we need to remind people that from 1 July, the conditions of putting the money in are still the same, but the amount is changing. So from 1 July this year, if you're under 65, the amount moves to $110,000 a year, where you can bring 3 years together and put in one financial year up to $330,000. No work test is needed. If you're between 65 and 67, that is also moving to $110,000. No work test is needed. For those people over 67 and under 75, you will need to meet that work test of working 40 hours over a 30-day consecutive period. before you're eligible to contribute that $110,000. And again, the same rules apply. Once you turn 75, no further contributions can come through to your super. So these amounts are slightly increasing. So I would imagine, Phil, that you've probably got a few people looking at this. Well, there's a little bit more amount that I can contribute next financial year. I could be planning now for some of the limits, utilising the thresholds as possible, but then there's a little bit more from 1 July as well.
That's right, and you know, particularly with that bring forward rule, you know, it's actually, you know, 3 times the, you know, the extra 10,000 is $30,000 extra.
Yeah.
And I've already done some clients that we're going to be utilising that extra amount in the next financial year.
Yeah, it's certainly, we always love it when indexation occurs to increase the threshold.
Yes.
So I suppose the next way, there's other ways that we can look at. I suppose to keep it brief, Phil, would you mind running us through the downsizer provisions just quickly for those members?
Yeah, sure, Paul. Briefly, this was a you know, something that the government introduced a few years ago now. Once again, it's being utilised, you know, quite a lot. It's for people that have basically selling their home and they're over 65. Then they are potentially able to put extra money into superannuation. They don't have to meet a work test. So we've been talking about that work test. These people are over 65 and beyond, and they do not have to meet a work test. The limit is $300,000 each. So for a couple, that's, you know, up to $600,000 extra that can go in.
Yeah, and there's certainly got to remind people is the fact that there are some significant time restrictions for this downsizer contribution. You only have 90 days, I think it is, from the settlement date of the sale of your house that you've been in for more than 10 years. So if you are looking at that, I would suggest you speak to the fund in regards to that. I suppose to cover off the other 2 items there is that spouse contributions, it's probably one of those ones that's not often spoken about, but if you've got a spouse that has a lower income for this financial year, you can make a contribution to the fund and receive a tax rebate for yourself. I do know of a tax agent that always loves to hear of the word tax rebate. So certainly they are beneficial. I would suggest you call the call centre or ring the fund or speak to your regional manager in regards to those. If you do have other superannuation funds out there, you can also bring them together closer to retirement to make sure that you've got this one pool invested appropriately and look at a one-stop solution for your retirement planning. And that may be that you use those to all purchase an account-based pension or allocated pension plan. The one thing that I would remind people is that we will be coming to it later, is talking about the differences between a pension and a super account. The one thing is that to get the money into super, or to get the money into that tax nirvana or tax-free environment when you're retired, it's got to come through a super fund's door first. So you need to make those eligibility criteria that we've mentioned for concessional and non-concessional to get the money in prior to retirement to get it into a pension account at the end of the day. I suppose, Phil, if I've been asked, given $1 or asked for $1 every time I got asked the question of how can I access my super, I probably wouldn't be here tonight. I'd be a very wealthy man. The one thing that we need to reassure people is that with the rules as they stand, there is a great amount of flexibility for retirees. Once you've met a condition of release, and that is reached your preservation age, and that could be greater than 58. I won't go through the conditions through the phases, but certainly once you've reached 58 and genuinely retired from the workforce, you have the option of taking a lump sum out still, which means that you may utilise it to pay down debt. You may like to do some renovations to the home, buy a caravan to go touring around. So there still is that wonderful restriction. Now, for those people over 60, you can withdraw money out in a lump sum tax-free, which is a great way of accumulating wealth in retirement. For retirement, once you've retired, you can draw some out. But more importantly, the trend, I think the greater trend, is people utilising their superannuation to purchase an income stream. So I would imagine, Phil, that you have people that do a little bit of a both, do a little bit of a lump sum, a small lump sum to do things, and then leave the rest for an account-based pension. Would that be correct?
I mean, that's right. I mean, by far, most people that I would see have come in looking for an income in retirement and very conscious of trying to make their money, their retirement savings last a long time.
Yes.
Lump sums, yes, there are people that take money out for all sorts of different reasons, as you've said, Paul. Some, if they've got some debt left or something like that, it might be to retire some debt when they retire, so they'll be debt free and things like that. Yes, I mean, the majority of the people are not just simply cashing the money out to put it in the bank, particularly given the low interest rates at the moment.
Yeah. Certainly.
Yeah.
It's a bane of content for some of the retirees that are out there.
Yeah, it's a big issue.
I suppose when you look at, I've mentioned before that to get money into that pension account, it needs to go through a super fund first. So during your working life, you're a member of a superannuation fund, you make contributions, your employer makes contributions, you can do top-ups, you can roll over other funds that you've got, or even do a downsize of contribution. But they all must go through the superannuation fund's door. Remembering that when you're in a superannuation fund, the earnings are taxed up to 15%. I suppose the one thing is that give people the peace of mind is that once they met a condition of release and they're looking to purchase an allocated pension or an account-based pension, the one thing is that I always explain it, it's like superannuation in reverse. You can take regular pension income out. So if you're over 60, that can be tax-free. If you want to update the car, do some other further renovations down the track, you can still take lump sum withdrawals out, which is also fantastic. So it gives you flexibility and control of your funds in retirement. You can take the lot out if you wanted and weren't happy with the product. So certainly you have that aspect of control. I suppose the other item is that once you're in the product, you then have the choice of investments of where you place these funds. So Phil, can you go through in regards to, well, yes, people mostly look at the pension account, how they derive their cash flow and what sort of investment structure they look at?
Oh, okay. So with an allocated pension or account-based pensions, look, we're talking about investment choice and things like that. It's not unfamiliar territory here for a lot of people I see who have already got super accounts. It's the same general principle in that super funds will generally offer a range of different investment options with varying degrees of risk and return, invested in different things, and people can choose how they what is the appropriate mix for them. We help. Obviously, as financial planners, that's one of the main things that we do, to help people choose how that money should be invested in that way. It can be changed. It's not generally locked in to a particular investment option. Likewise, on the income side of the allocated pension, the law basically requires that a minimum amount of money is drawn out per year. Varies with age, but to give you an example, people over or people under 65 will generally be are required to take minimum of 4% out per year, 4% of the account balance. People between 65 and 75 is 5% of the account balance is required to be taken out each year. But the point is that you can take anything above that as long as you've met that minimum requirement, and you can change that amount if your needs or your lifestyle expenditure change. So yeah, I mean, I think it's important to emphasize that hopefully people are getting a sense that these pensions are quite flexible and can vary with changing circumstances in lifestyle.
Lovely. So within our pension account that we provide, we've got 2 different options that you can choose. And within those options, there's a few more step down options. Phil, would you mind running us through the differences between our 2 different products that we offer at Australian Catholic Super?
Yeah, sure. Okay. So, so we're talking about, we're talking about these allocated pensions or account-based pensions. They are financial products, and Australian Catholic Super has 2 allocated pensions, just like Paul said. One is called Retire Choice, and the other one, which we're about to talk about in a minute, is called Retire Smart. Obviously, this slide is talking about the Retire Choice. So, what Retire Choice does is give the client a variety of options, just like I was talking about a minute ago, about how the money may be invested. So once again, I'm talking about how to invest the money in terms of the level of risk that you want to take, the sort of returns that you're trying to get, the types of things that you want to invest your money in. Retire Choice will give you options in that regard. And thank you, Paul. Perfect timing. That's there they are. There are the investment options within Australian Catholic Super. Some of them are what we call a pre-mixed bundle of investments. Some of those names that you see on the left-hand side of that table would probably be familiar to people. Things like Balanced Growth, Capital Stable. The fund has decided a pre-mixed choice of investments within that. And you can choose which one of these funds that you might want to invest in, and you can have a mixture of them in it. On the right-hand side, the single assets is where you're investing in only what we call single asset class. So you say, for instance, well, I want to have all my money in Australian shares. Then that's available to you as well. So it can be quite tailored to your individual preferences.
Lovely. And then Retire Smart.
Okay, so this is the other product that we offer, and this one is sometimes it's called more a sort of a more like a strategy where the fund is doing a lot of the investment choice for the client, in the sense that the client doesn't choose how the money's actually invested like it does in the Retire Choice. The fund operates on what's called a 2-bucket model, and I think there's another slide coming up with the buckets in it. Yeah. The idea is this, that the majority of your money is invested in a bucket, growth assets. The money's trying the general principle is try to keep that money there to invest for the long term. The markets might go up and down, but over the longer term, experience has shown that that money left to its own devices will grow for you over the longer term. However, it's a pension, and so you need money to live on. And so what Retire Smart does in that particular case is it says, all right, well, let's have a cash bucket as well, and we'll draw the pension payments out of that that bucket. And as that bucket gradually reduces because you're drawing your money out to live on, then the fund is automatically distributing money between the 2 funds so that you can afford to take your pension payments and you've still got the majority of your money there for the longer term.
Thanks, Phil. I suppose if you wanted to find out further information in regards to these 2 different types of products, there is a fair bit amount of information in our product disclosure statement for retirement planning, and that provides a little bit more information. I suppose in regards to the next area that we're going to cover off is the age pension eligibility. I mentioned at the top of the hour, or the start of the presentation, we actually started at 5:30, not the top of the hour. There is an age pension webinar. So just very briefly, we thought we'd mention the changing rules as when you become eligible to the age pension. So Phil, could you take us through those, please?
Yeah, sure, Paul. So as I said, we're just talking sort of a very high level here today because there's a separate presentation about this, but the age pension age is increasing slowly over time until to 67. So by that I mean the one of the criteria to get the age pension is you've got to be old enough, basically, and the government is slowly putting the age up. So as you can see there, depending on exactly when you were born, there's certain ranges. But basically anyone that was born on or after 1st of January 1957, it's going to be 67. I won't read out the actual dates for you. You can see for yourselves, but you can see that it's going up incrementally from 66 to 67 over the next, by July 2023, it will be 67.
Lovely. Thanks, Phil. I suppose we've spoken about, well, what sort of, I hate to say that budget word, B word, the budget. So we've looked at what people are spending in retirement and touched on what sort of an asset base people might be looking at. We've looked at contributions coming into super, both on a concessional and non-concessional basis. And then we've looked at, well, what you do with your super and account and retirement, and looking then at allocated pension or account-based pensions. I suppose that we've covered off a large number of points. I suppose the one thing that we need to address, Phil, is can you go through and provide us a bit of an update on how you can assist people through all of that information and bringing it all together?
Yeah, sure. Thanks, Paul. So, yeah, I mean, look, today's session has been a high-level discussion to try to introduce topics and give people some basic information to help them to begin to understand what is quite a complicated area. Superannuation, Centrelink, the tax department, they're all issues that when you say the words themselves, people start getting a bit nervous quite often, and largely that's it's largely because it's complicated and they're all interacting with each other. That makes it even worse. Look, we see our role as financial planners basically to try to help people to look through what's really going on and how all these things can interplay and to your benefit to help with the planning of your retirement. Okay, so some of the things that we're looking at quite on a common basis with clients is how much Centrelink benefit will I get? How long will my money last? Is a major question, obvious question that everyone wants to know. We give a lot of we give projections and tools which we have, which try to help answer these questions about how affordable retirement, how much money do you need to live on? All these sorts of things are all things that we look at when we're creating a financial plan for you. Some of the well, we've already talked about it. We started this seminar talking about your goals. That's where we start. What are your goals? And then we try to sit down and work out how we can put the plan together based on your goals and our understanding as professionals of how these rules could be made to work for your advantage to help fund your retirement. It is worth noting, sorry, Paul, that a lot of people don't realise we don't just have to advise, or we don't just advise on super. We work for the Australian Catholic Super, but our license to advise is more broad than that, and we do also invest on investments outside of super, and not just invest people's or clients of Australian Catholic Super quite often bring their partners to our meetings, and they're not with Australian Catholic Super, and we can potentially also advise with them as well.
I suppose, Phil, that one thing that we've got to advise tell people is that, well, whilst yes, you can do a document that's a strategy document that tells you of the the dollar savings that will be provided, that covers off the tangible items and how you're going to fund your retirement. Can you just take us through what else other benefits that can they provide as well?
Well, I think that's the whole point, Paul. That there is there has to be tangible benefits. Dollars are important. Why would you want to see a financial planner if it didn't financially advantage you? Of course, we're trying to do that, but I think a big thing that results from the work that we do is the peace of mind. The peace of mind that comes with having someone look at your situation and being able to determine that this situation is achievable or affordable, or at least here is the goal. Gives people a path to a goal to aim for. These things, people, most humans like to know that there's a plan in place to achieve their goals, and that that's definitely for particularly retired people. Generally speaking, they're not going to have an income, or they're not going back to work. That's not the plan. They're retiring, and therefore having peace of mind that for instance, that they've got enough money, things like this, in my experience, is worth a lot to people.
Yeah, for sure. I'll take you through now what actually where we can assist you further. My colleague Justin is going to drop into the chat area a link that you can use, so that if you do want further information from the fund, you can quickly click on that link and take you through and put in your details, and a fund member or a fund staff member will actually come back to you with a phone call in the next few days and assist you where possible. There are really three options that we can provide you with assistance. The first one is general advice. So we've got the call centre available to you. You've got regional officers and regional staff, regional managers around the areas can certainly assist with your general inquiries. So they can provide you with details of what we've gone through with you tonight. We cannot provide you with any recommendations and the like. That would be classified as advice, and therefore we would recommend that you seek and go through our advice channels. The one in the middle there, the over the phone advice option, is available to people, and it is based on single topic advice, and it is done over the phone, and it is at no further cost to you. The great thing with this service is that yes, you can review and have a look at which investment option should I consider. How much should I salary sacrifice? I know that we're talking about retirement planning, but some people may need to have a look at their insurance options. So they're the types of questions that you can fire to those people. We can do it may take up to an hour of your time. That is the only cost for you. So certainly they can sit down with you over the phone and go through with you which investment option, how much should I salary sacrifice. That is available to you. So that is what the over the phone advice service is. Phil, can you take us through, you're obviously a comprehensive advice financial planner. Can you take us through the process of what people would expect to go through with going and seeing a financial planner?
Okay, thanks, Paul. So with comprehensive advice, we are, generally speaking, we're looking at a person's entire financial situation. So the over the phone advisors will generally only be looking at contributions, in this case, into the Australian Catholic Super Fund, or something to do with a transaction within the fund itself, right? They're not going to be, they're not licensed to be able to provide advice on any other investments which are outside of that area. Whereas comprehensive planner, as the name suggests, is able to take a broad picture of your entire financial situation. And once again, give an example, quite often we're dealing with couples, and one partner may be with Australian Catholic Super, the other one may not. We would potentially be able to look at the entire situation for the couple. Because because we're looking at your entire financial situation, our process is basically to try to initially understand your situation so that we can try to identify what areas that we could potentially help you with. Because of that, the way that we operate the practice is that we generally will offer the first appointment is free, and that first appointment is, as I say, it's to try to understand client situation and what potential areas we could see that they could potentially receive advice about. In that meeting, our aim is to, having understood the situation and what potentially could be done, is to then try to relate that back to people's goals. And then if people would like to receive advice from us, then we will quote them for it. So we're a fee for service. But everything is quoted. We'll give you, we'll look at what we could potentially do. We'll quote you what the price will be. If you wish to engage our services, then after that we will write you a written report called a statement of advice, which we will present to you at a later date. We will also, generally speaking, also do the paperwork involved in any recommendation that that we make as well. So we'll quote you the price. If you're happy with that, we'll often do the work. If you're not under any obligation. And it would be just left at that until such time as you wanted to potentially receive advice. I guess to give you people an idea, I mean, how much do we charge for this type of service? Well, it varies. It basically, the principle is it's based on how much work's involved. Generally speaking, it can range anywhere from I don't know, $500 to $3,000-4,000 is typical. It could be, it's not generally going to be much less than $500, but generally speaking, yeah, most of the work I do is around somewhere around the $3,000 mark.
For sure. And that amount can be taken from your superannuation account if it's related to superannuation advice? That's
right, and we can tell you that in the when we quote you. How much? Probably not necessarily all of it can be, because there's laws around that, but yep. We can tell you what that could be.
Lovely. So again, if you wish to click on that link and make yourself available of the fund services, click the option that you would prefer, and then someone will be in contact with you at a later stage. We are having webinars coming up soon. Traffic behind me tonight is getting a little bit noisy. The webinars that we've got coming up, we've got an investment webinar coming up very soon, next week. We've got a Centrelink webinar where we go into the full details of Centrelink eligibility and criteria. For those people that are looking at aged care, it might not be for themselves, but they might be actually looking at for their parents or family friends. That certainly will run through what you should look out from a financial aspect when selecting an aged care facility. And then obviously we will be conducting more of these retirement planning webinars. Also in your local regional offices are in the current phase of planning their face-to-face seminars. We will be having those online soon. The one thing that I would remind people is that the portal is available. The portal has been certainly changed over the last few years, and it has been enhanced. The great aspect is that you can go through there and have a look at your investment balance or account balance. I'd suggest that you don't look too regularly. The movements in the markets could shock you, but I would suggest that you actually have a look in. You can have a look at your investment options. You can make change your investment options if you like. You can make make a contribution to the fund, a non-concessional post-tax contribution. You can have a look at your insurance. So I would suggest you have a look at the portal. We also have a planning tool, what we call Raptor, or a projection tool. So some members may have that on the facility there, where they can go through and have a look at where they likely to have their account based when they get to retirement. So that is certainly available. I'll now bring on Justin Colley, who's been fielding our questions for us tonight, Phil. So Justin, are there any questions that we have from the audience tonight?
Thanks, Paul and Phil, for a very informative session so far. We've had 11 questions come in so far, but I can see some of them we have actually covered through the webinar, but that were asked actually before we came to the points. But I will touch on them. You may just want to briefly reinforce some of those points. So I'll just go through them. Our first one is, I'm retired, have been so for 7 years. I'm turning 60 in July and want to know if I can access my funds fully tax-free on my 60th birthday.
Yeah, could we answer that?
Yeah, you can go for it, Phil.
Oh, sorry,
you can be first up if you like.
Yeah, well, certainly if Australian Catholic Super, the money, when you are over 60, the money is tax-free. And if you've retired, I think you said 7 years ago in the question.
Yeah.
So, yeah, you've met your what Paul talked earlier in the presentation about condition of release. You've met a condition of release, so you would be able to access the money, and yes, it would be given back to you tax-free at 60.
I would suggest also that on the form that they would need to sign a statutory declaration stating they've genuinely retired from the workforce before they have access to the funds. But that statutory declaration, we can provide that to you for signing off.
Thanks, Paul and Phil. Phil, I'll ask you this question. You were talking about the contribution caps earlier, and the question is, what is the consequence of going over these contribution caps?
Yeah, I think we did answer that a little bit on the concessional side. There is a penalty tax on the concessional contribution, but it effectively is the tax that you should have paid, because remembering salary sacrifice has reduced your tax. So what the government is saying is, well, you haven't paid enough tax. So the government is looking for that money back, but they're acknowledging the 15% contributions tax you made or was made when the money went in. So basically, it's the tax that you should have paid less 15%. Plus there is an interest penalty as well that they impose on that as well. With the concessional, that is the concessional contribution. The non-concessional contribution limits, if you break them, there is a very hefty penalty. It's up to, I think it's 47% of the amount of money that you contribute over in excess. You could potentially be charged. Okay, and once again, I mean, Paul and I mentioned, I think Paul said something like, you just really don't want to go there, or something like that. That's right. It can be, and I have seen it. I have seen people with very, very large penalties. It's not, I'm not trying to scare people, and it's not a fait accompli by any means that you will be paying that tax. But is it potentially possible? Well, yes, it is.
Thanks, Phil. The next question is, can I have a copy of the PowerPoint to be sent to the participants? I might just answer that quickly. We don't usually send the PowerPoint presentations out to our participants, but what I would say is that this webinar is actually being streamed live on Facebook. So you will be able to go to our Facebook page and see a recording of this webinar at any time, that you'll be able to go back, and all the slides are on that recording. They're on our Facebook page. Now, the next question I have is, and it relates back to the ASFA comfortable lifestyle. And I think you quoted an amount of 640,000, Phil, earlier on. But the question is that $600,000 for a couple or for each one in a relationship? Oh,
yeah, no, it's for a couple. It's a couple. Yeah, I think I said it was a bit over 600,000 there. That's right. Yeah. But no, it's definitely a couple, for a couple.
Okay, so I think it's the ASFA standard actually is 640,000 for a couple, and for a single person it's 540,000 for memory. So the next question is, I'm already retired and 59 years old. Does anything, and I'm personally contributing to my account until age 60. can I withdraw my funds tax-free? I guess that's another person who's asked pretty much the same question which you just answered. So we'll move on to the next one. Is the SG contribution definitely going to 10% in July, Paul?
Oh, the word definitely. When we're dealing with governments and budgets and political announcements, all I'll say, and I'll toe the line and say that at the moment that it is legislated to go to eventually 12%. So therefore it's going to go to 10% from 1 July. But with all legislation and with all rules, governments can change them at a whisk of a pen. So we've got budget night next week. There would be an announcement there, I would imagine, if they're not going to proceed with that increase. But as far as we're concerned, it's legislated and going to happen, providing Josh Frydenberg changes his mind on Tuesday next week.
Thanks, Paul. Now, Phil, the next question I have is, with comprehensive advice, could this include mortgage advice?
Yes. So debt or debt reduction, debt management is one of the things that we could potentially advise on. So yes.
Thanks, Phil. I know you touched on this towards the end of the presentation, but I'll just get you to just repeat it. What are the fees associated with your service?
Okay. So what I said was we quote each individual job separately. That's the first thing. So and it's based basically on how much work is involved in it. But generally speaking, the range is usually somewhere between about $500 and about $4,000. Most of the reports I think I would write are probably on average about $3,000. But we would quote each client based on what the work was.
Thanks, Phil. The next question we have is in regards to the Retire Smart pension. How often does the cash bucket get adjusted to ensure there is enough cash available to pay regular monthly income?
I think that top up, does that occur quarterly based on investment performance? Within the Retire Smart, is that correct, Justin?
I believe so. Yes, that's right, Phil. Sorry, Paul. Yes.
Yeah, that's what I thought.
Yeah. So how
you got me stumbled there? I was thinking.
How long before retirement should you start organising a pension account, Paul?
Well, I would suggest that we've got to wait for the final contributions all to come through. So that yes, you might be ceasing employment or you might be going on long service leave. Essentially, we need to wait for the final contributions to come in, and then we transfer all over to the pension, if that's what you want to achieve. I would suggest that a month or so prior, if you're just wanting to start an allocated pension plan, it shouldn't take too long. It's just a matter of completing forms. We can do that via email or over Skype and the like, or come into one of our regional offices and assist you with that. But it shouldn't take too long. We would just need to go into consideration. So probably best to contact the fund prior to doing so.
Thanks, Paul. I might make this the last question because I am conscious of time. And it's regarding the assets test. I know we do have a specific Centrelink session or webinar will be held later this year. But it is, what is the total value of assets, funds, before you stop getting the age pension? So can you answer that one, Phil?
Off the top of my head, I think the figure is for a couple, it's about $880,000 now. It's of that order. Yeah.
Thanks, Phil. Thanks, Paul and Phil. That's the last of the questions. I'll hand it back to you to wrap things up.
Thanks, Justin. I might just cover off those two questions that I got sent prior to the session starting tonight. And that was regards to regulations working post-retirement. So essentially, yes, you can continue to work. There are rules based on Centrelink entitlements that you need to factor in on terms of how much you earn. I would suggest that you attend the Centrelink webinar, and that'll give you an indication of how much you can earn once you've become age pension age. But yes, you can keep working. We have a lot of members still doing some form of part-time or casual work once they've retired and reached the age pension age. So certainly that is there. on how much investments you can have. Again, that will be covered off in the Centrelink webinar that we have. I also had a question, Phil. I suppose that I can run this one by you and can confirm. We had someone that wanted to have an indication on future performance of our Retire Smart option. The one thing that I would have in mind is that, well, whilst we don't have crystal balls, and I'm pretty sure that we wouldn't be sitting here if we knew where investments are going to head. But can you give a member that's wanting to look a bit of where we're going to head for the Retire Smart option?
Well, I mean, I think we can only really tell. We've got data about what the fund has earned.
Yes.
And that's available on the website. My understanding is that what have we got? I think the Retire Smart has been around for about 5 years. I understand, and I think the return on the Retire Smart was about 6%.
Yes, 70%. That's correct.
Yeah, yes. Of course, you know, you'll always hear this when you start to talk about the future performance. There's no guarantees about that, but I think the other thing which is also on the website, isn't it, that
Yes.
it talks about the aim of the fund. The aim of the fund, what's it trying to achieve? And I think the stated goal is to achieve 3% over and above the rate of inflation over a rolling 10-year period.
Correct.
So, you know, if that gives people an idea of that, that's what the fund is aiming to achieve.
Sure. And given the fact that we haven't got 10-year historical performance, I suppose the one thing that we could say is that it really doesn't matter where it's going, where it's been. I suppose we can only provide you with an indication of where it's going to go to. And to answer that question, we just don't know. We can provide you to the objective of the portfolio, that being that 3% over CPI or inflation, but certainly where we think it will hit, we do not know. But I would certainly suggest that if that person wants any further information, to contact me or the fund, and we can provide you with further details. Phil, that's about it for us tonight. I suppose the one thing that I need to clarify with is the contact of the fund. If you wish to contact the fund, you can there on that 1300 number. The one thing that I would suggest to you is that after tonight's session, we will be forwarding to you a survey. The survey will provide you with information in regards to the webinar that we've seen tonight, and also give you another opportunity that if you wish to have further information from the fund, you can do so. So certainly that survey will be sent in the next few hours, and you should be in your inboxes there for tomorrow morning if you want to make further contact. Again, thank you very much for your time tonight, Phil. Appreciate that. And again, for everyone that's attended, I hope you have enjoyed the session that we've put on here tonight. If you've got any further information, please do not hesitate to contact us on that 1300 number. We're more than happy to field any questions. Again, thank you very much and have a good evening. Bye.
Thank you. Bye-bye.